How to start investing in gold and precious metals. Gold is one of the very few assets that exists outside the digital financial system. It does not rely on servers, software, or institutions to exist. And yet, it is priced every second by some of the most advanced markets on Earth. This creates a paradox. In an era defined by speed, leverage, and abstraction, why does something so slow, heavy, and inert continue to matter? The answer is not emotional, and it is not mystical. It lies in how modern financial systems are built, and where their limits are. Why precious metals still exist in modern economics. Modern economies are built on trust. Trust in institutions, trust in currency issuers, trust in legal systems, and trust in future productivity. Precious metals exist as assets that require less trust than most financial instruments. They are not claims on future performance. They are not contracts. They are final settlement assets. This characteristic does not make precious metals superior. It makes them different. And in economics, difference is often the source of relevance. Historical role of gold. Gold did not become money because governments declared it so. It became money because markets selected it over centuries of trade. Unlike paper currency, gold could not be printed. Unlike livestock, it did not perish. Unlike land, it was portable. These traits made it economically efficient. Over time, governments formalized gold's role by tying currencies to it. This created discipline and constraints. Those constraints eventually conflicted with economic expansion, war financing, and modern credit systems. Why the U.S. moved away from gold. The abandonment of the gold standard was not a failure of gold. It was a response to the complexity of modern economies. Fiat currency allows monetary policy to respond dynamically to recessions, banking crises, and demand shocks. But flexibility introduces fragility. Fiat systems require constant confidence management. Gold remains in the background as a reference point, not a controller. Different precious metals. Gold is primarily monetary. Its industrial use is minimal relative to its total demand. Silver is hybrid. It responds to both monetary forces and industrial cycles. Platinum and palladium are tied heavily to industrial supply chains, making them sensitive to technology shifts. This means precious metals is not a single asset class. It is a category with internal diversity. At this point, most discussions about gold become emotional. This is where this video goes in a different direction. Because the most important question is not whether gold will go up, but why people continue to interact with it at all. And to answer that, we need to look at incentives. How to start investing in gold and precious metals. Why economic actors continue to use gold. Every participant in the financial system operates based on incentives. Governments, institutions, corporations, and individuals all respond to different constraints and motivations. Gold persists because it satisfies specific incentives that no other asset fully replaces. For central banks, gold represents a reserve asset without counterparty risk. It does not depend on the solvency of another nation or institution. This makes it uniquely useful during periods of geopolitical or financial stress. For institutional investors, gold functions as a portfolio component that behaves differently from equities and fixed income under certain conditions. This difference, not performance, is the core incentive. For individuals, gold often represents tangibility in an otherwise abstract financial world. This is a psychological incentive, not a financial guarantee. Interest rates, opportunity cost, and gold. Gold does not generate income. It does not pay interest, dividends, or cash flow. This characteristic is central to understanding how gold interacts with interest rates. Opportunity cost refers to what is given up by choosing one asset over another. When interest rates are high, holding yield-producing assets may appear more attractive than holding gold. However, Nominal interest rates alone do not tell the full story. What matters is the real interest rate, the return after adjusting for inflation. When real rates are low or negative, the opportunity cost of holding gold decreases. This is a mechanical relationship, not a belief-driven one. This explains why gold often enters economic discussions during periods of aggressive monetary policy or high inflation. Not because of fear, but because of arithmetic. This explains why gold often enters economic discussions during periods of aggressive monetary policy or high inflation. Not because of fear, but because of arithmetic. When the dollar strengthens relative to other currencies, gold can become more expensive for non-dollar buyers, affecting global demand. Conversely, when the dollar weakens, gold may appear more accessible globally. This relationship is not fixed, but it is persistent. This interaction highlights why gold cannot be analyzed independently from currency markets. Behavioral economics and gold. Human behavior plays a role in every market. Gold is no exception. However, behavioral influence often manifests at extremes, not in normal conditions. During periods of uncertainty, narratives surrounding gold can become amplified. Media coverage often shifts from data to emotion. This is where misunderstandings arise. Gold is not reacting to fear. People are reacting to uncertainty, and gold becomes part of that response. Separating asset behavior from human narrative is critical for understanding precious metals accurately. Common errors in how people think about gold. One common error is treating gold as a guaranteed hedge. No asset performs consistently across all environments. Another error is assuming gold replaces productive assets. Gold does not generate growth. It reflects conditions. A third mistake is ignoring storage, liquidity, and structural differences between physical and financial exposure. Understanding these errors is essential for building realistic expectations. Long-term scenarios. 2030, 2040 context. Looking forward, gold's role will depend on macroeconomic coordination, debt sustainability, and confidence in monetary governance. Technological advancement may increase industrial demand for silver and platinum, particularly in energy systems and electronics. Geopolitical fragmentation could increase interest in neutral reserve assets, though outcomes remain uncertain. No single scenario guarantees a specific outcome for precious metals. Gold and precious metals are not predictions. They are reflections of how economic systems manage risk, trust, and scarcity. Understanding them improves understanding of the financial system as a whole. If this video clarified how gold fits into the economy, the next logical step is understanding how interest rates influence stocks, housing, bonds, and commodities simultaneously. This video is for educational and informational purposes only. It does not constitute financial, investment, or legal advice. No outcomes are guaranteed. Viewers should conduct independent research and consult qualified professionals before making financial decisions.